Understanding leveraged buybacks, mechanics, impact, and recent developments. A leveraged buyback is a strategic financing maneuver employed by corporations to enhance shareholder value by repurchasing their shares through debt. This practice not only reduces the number of shares outstanding, but also boosts the earnings per share (EPS) for the remaining shareholders, which can lead to improved financial metrics such as return on equity (ROE) and price-to-earnings (PE) ratios. Key insights into leveraged buybacks. Debt financing for repurchases. The core of a leveraged buyback lies in using borrowed funds to execute stock purchases. This places additional debt onto the company's balance sheet, a financial maneuver that couples risk with potential reward. Reducing shares outstanding. By repurchasing shares, companies decrease the total number of shares available in the market. Consequently, the EPS rises since net income is now distributed over a smaller pool of shares, creating an appealing prospect for investors. Hostile takeover defense. One of the less discussed benefits of leveraged buybacks is their role as a defensive tactic against hostile takeovers. The added debt can dissuade potential acquirers from making bids for the company, as it demonstrates a commitment to maintaining share value, albeit at the cost of increased financial leverage. The mechanics behind leveraged buybacks. On a theoretical level, leveraged buybacks ideally don't have an immediate influence on share prices after accounting for tax benefits and elevated interest payments from the new debt. However, the introduction of substantial debt can compel corporate management to enhance operational efficiency to fulfill higher repayment obligations. In doing so, companies might resort to cost-cutting and downsizing measures, which may affect employee morale and productivity. Distinction from other financial maneuvers. It's essential to differentiate leveraged buybacks from leveraged buyouts, LBOs. While the former involves a corporation repurchasing its shares, the latter concerns establishing ownership of another company through significant debt financing. Additionally, contrasting dividend recapitalizations, wherein leverage is employed to pay a one-time dividend, untouched by ownership structure changes, leveraged buybacks affect the pool of shares held by existing investors. Impacts on financial metrics and investor sentiment. Employing leveraged buybacks can manifest an inflated understanding of company performance. Although the immediate effect might appear beneficial, evidenced by rising EPS, a company's long-term value might not necessarily improve. Critics argue that this strategy reflects a form of financial engineering rather than operational advancements, noting that executive compensation in many corporations is often tied closely to EPS figures. This has proven a successful tool for companies seeking to manipulate financial metrics to please markets and investors. Historical data illustrates that between 2008 and 2018, U.S. corporations allocated over $5 trillion to buybacks, which constituted more than half of their profits. Major corporations, such as Procter & Gamble and Eli Lilly, saw nearly 40% of their EPS growth attributed to buybacks. Regulatory landscape, the future of leveraged buybacks. As leveraged buybacks gain traction, so too did the call for regulation. In light of concerns regarding market manipulation and corporate governance, the U.S. government has begun to impose taxes on buyback activities. The Inflation Reduction Act of 2022 introduced a 1% excise tax on stock buybacks exceeding $1 million, a move that aimed to curb excessive share repurchases and prioritizing corporate investments in growth. President Biden's statements. During his 2023 State of the Union address, President Biden proposed a quadrupling of the tax on corporate stock buybacks. While it remains unclear if this proposal encompasses leveraged buybacks specifically, it signals a trend toward stricter regulations in this area. SEC and transparency. The SEC has also highlighted the importance of transparency through enhanced reporting requirements concerning stock buybacks, addressing potential abuses in the system. Conclusion. Leveraged buybacks are a prominent feature in the toolkit of corporate finance practices aimed at maximizing shareholder value in the short term. However, while they can yield immediate financial benefits, they also raise significant ethical and operational concerns regarding long-term company health and employee relations. The backdrop of increased scrutiny from regulatory bodies and potential future legislation marks a critical juncture for leveraged buybacks in the corporate landscape of the United States and beyond. Companies and investors alike must navigate this intricate financial strategy while closely monitoring legislative developments that could reshape the approach to share repurchases.